Hello and welcome. My name is Jonathan Stav, and here at Sectors Made Simple, we've created over 200 hours of educational content and unique investment tools to give you the knowledge and resources you need to invest simpler. Today, I have a question for you. What if instead of trying to decide between what stock to buy, or even when to buy it, you could buy and hold a single gift basket of stocks that has been handmade? That's exactly what funds provide us. So today, we'll go through the basics of funds and give you a stronger idea of why this investment type is something that you should be considering. With that said, let's take a look at the goals for today's video. In this video, you will learn about what an investment fund is, what benefits these funds provide to investors, what the two main types of funds are, the costs that come with these funds, and some places that you can start your research to find the best fund for you. Let's get into it. Let's start off with the basics of what an investment fund is. In simple terms, an investment fund is a group of investors who pool their money together to invest as one big portfolio. But typically, you don't need to worry about managing those investments yourself. Instead, funds will have either a person, known as a portfolio manager, or a computer that will buy and sell securities on your behalf. As a result, the hope is that over time, the value of the investments go up, increasing the value of that portfolio and increasing the value of the shares that you hold in that fund. Now, all of these benefits do come at a cost, so there are some additional expenses that come along with investment funds that we'll talk about. But first, let's talk about the more fun stuff. Why investment funds are a valuable thing for us to consider when we're thinking about investing. To explain what benefits a fund can provide us as investors, we shouldn't look at the stock market, and instead, let's go and take a look at our grocery store. When you go to the grocery store and go to the candy aisle, there's going to be a wide range of candies. Not only different kinds of candies, but different companies. Milk chocolate, dark chocolate, 70% dark chocolate. I don't know about you, picking between all of those choices can get pretty overwhelming. The same thing can happen with stocks. There are over 5,000 stocks that we can invest in, and trying to pick which one to buy and when to buy it is challenging. So, much like when we go to the candy aisle, you might find a big gift basket. This very nicely presented group of different types of candies that are put together for some purpose. They might be candies for dark chocolate lovers. They might be caramel. They might be themed around a holiday like Christmas or Valentine's Day, but all of them give us one main benefit. It's a bunch of different things that have been put together for us, and all we have to do, instead of buying each one of those individual pieces of candy, we can buy the entire basket. Funds are exactly this. Funds are a gift basket of different types of investments that instead of needing to pick all of the different things that go into the basket, we can just buy the gift basket as a whole. Pretty neat, right? While funds won't give us the exact same options as you might see in a gift basket in your local grocery store, there are many different types of funds that will offer investors different opportunities. Some of these might invest in a specific type of company. Some of them might invest in a specific country. Or others might help you to maximize how much returns you might see by some target date in the future. But before we get into all of the different flavors of gift baskets that we can buy, let's first talk about the two main types of funds: mutual funds and exchange-traded funds. While these both are funds, there are a couple of similarities and differences that we should be aware of and should be considered when deciding which one is the best opportunity for you. So let's take a look at some of those. Let's start off with the similarities. Both ETFs and mutual funds are a pool of money that is used to invest in various kinds of securities. While there are going to be different types of both of these funds, from ones that invest in sectors or types of companies, to company sizes, only big or only small companies, focused around social initiatives, such as clean energy and more. There are some minor fees associated with either mutual funds or ETFs. Now, let's take a look at how they are different. Let's now talk about the differences between mutual funds and ETFs. The biggest difference is in how they're priced and how they're traded. ETFs can be bought and sold through major stock exchanges, and as a result will have their stock price change when the markets open, aka throughout the day. For mutual funds, their price will only update once a day after the market closes, and will accept new offers to buy into that fund after the market's closed and after that new NAV or net asset value, aka their price, has been decided for that day. Another difference is the type of funds that are available to us. ETFs are a slightly newer idea, so there's not as wide of a range of offerings as there is for mutual funds. Additionally, there is a few types of mutual funds that aren't available at all in the form of ETFs. These being target date funds. Target date funds give investors a unique opportunity where the portfolio is managed to try and maximize its return by a certain date. For example, if you had a target date 2050 fund, the investments in that portfolio would start off a little more risky because 2050 is a pretty far way away. So they're going to do their best to maximize their profits early on, and as 2050 gets closer and closer, will start to slow down their investing, get a little bit less aggressive, and start to try and preserve the gains that they have built over the past 30 years. The last difference are the fees that these funds charge you for being a part of them. And unfortunately, it's not easy to just quickly bullet out the differences between these, so instead, fees get their own section. So let's cover those fees now. While no one really enjoys talking about costs, when we're trying to decide between what fund we would want to buy, understanding what costs there are and what those costs actually mean are an important part of our decision-making process. So, with that said, let's take a look at some of the fees that will be charged in either mutual funds and/or ETFs. Let's start off with the type of fee that you will see regardless of if you're looking at a mutual fund or an ETF. Expense ratios. Expense ratios are a percent of the portfolio that is taken out every day to cover all of the different fees that are needed to run that company or that fund. Now, depending on if the fund is passively managed, meaning the portfolio is managed by a computer, or if it's actively managed by a person, you might see higher fees or higher expense ratios associated with those actively managed portfolios. Now, again, this is going to be a percentage that comes out of the value, and you don't need to think about going in and paying it like your utility bill. Instead, it's deducted from the share price every single day, so you don't need to worry about it. The second type is going to be shareholder fees. These fees are unique to mutual funds and can vary pretty wildly because each mutual fund will have different fees at different points. And some might not have any of these. But here's the ones that you should be aware of, because when you're doing your research, you will come across these terms. Let's start off with redemption fees. Some funds will require that you invest with them for a minimum amount of time. If they do require that, they will also likely have a redemption fee, which is a penalty that you would incur if you sell out of that fund before that specific period of time. The second is going to be an exchange fee. Many funds are managed by a big family, and while you can jump around between the different funds within that same family, they might charge you a small fee for switching between one to another. The third is going to be an account fee. This is going to be kind of like how when you open a bank account, they might have a monthly maintenance fee associated with them. Many of these fees can be waived if you invest or you put a certain amount of money into it. Account fees for mutual funds are no different. Then we have purchase fees. Purchase fees will be a fee that is charged when you first buy into a fund and is typically going to be a dollar value instead of a percent of how much you're investing. Speaking of percents, we get to our final type of fee, load. Load comes in many different shapes and sizes, but is always going to be a commission that is paid to a broker when you buy or sell shares of a fund. Load comes in 3 different types. Front-end load, which means that you pay this fee when you buy into the fund. Back-end load, which is you pay the fee when you exit or sell the fund. And then finally, level load, which are yearly fees that are assessed to your account, again, typically on a % of how much you're investing basis. Now, here's the good news. Most mutual funds, because of the competition that ETFs have created, have done away with many of these fees. So while you might not see it in every single fund, I do want you to be aware of these fees, what they are, and what they mean, so that you can make a more informed decision if and when you decide to go and buy a fund. Finally, while we've covered a lot of information today, there are many websites that make researching and finding the right fund for you simpler. Here are 2 of my favorite resources, one for mutual funds and one for ETFs. For mutual funds, the website I typically use is morningstar.com. This website offers a vast array of information for investing in different funds, and while a good deal of that information is locked behind having a premium account, with no account needed, you can still get the information that you need, which includes the expense ratios, any load that fund might have, as well as the ability to see how well that fund has done over the past 1 year, 3 years, 5 years, and 10 years to find the fund that provides the best returns at the lowest fees. For ETFs, the website that I've found to be the most useful is vetify.com. On Vetify, not only can you see the historical returns of different funds, as well as the expense ratios that those funds charge you, but you can also screen to find funds that invest in a specific thing that you might be looking for. For example, maybe you want to invest in technology companies, or maybe you only want to invest in companies from Europe, or companies from China. There are thousands of options for funds, and Vetify is a great free resource to help find funds that will interest you. Now, let's wrap things up by summarizing everything that we've covered today. Funds are an opportunity for investors to pool their money together and have someone or something manage that money in different types of investments. Usually, these investments follow a theme or a specific market. And there are a wide range of both ETFs and mutual funds available that we can pick and choose from. ETFs might provide the lowest barrier to entry, being slightly cheaper and also slightly easier to buy, while mutual funds will provide us more flexibility and some types of portfolios that aren't available as ETFs. There are free resources online, such as Morningstar and Vetify, that will help us to understand what fees are associated with these funds, what they're investing in, and most importantly, what their returns have been. So, that's all the time we have for today, and that's the basics of funds. Hopefully you found this information to be useful and helps you to understand the stock market and investing a little bit simpler. If you feel that this video has been helpful, we really would appreciate a like and a subscription. It is a free investment on your part, and it does a lot to help us to understand what content you want to learn more about, as well as to stay informed for when we release more of these videos. So thank you all so much for joining us today, and we hope to see you all very, very soon.